Have you ever wanted to know the key issues involved in purchasing rental real estate? Do you want to understand what risks you want to avoid when purchasing rental properties? Do you want to know the actual steps you need to take to protect yourself from these risks? If so, you're in the right place. Stay tuned for the answers to these questions and many more. Hi, I'm William Dolan, and this is Esquire Advice, where we explain complicated and lucrative real estate and business topics. Remember, we are not forming a lawyer-client relationship by way of this channel. Always consult your local attorney before taking any action. With that said, grab a pencil and a piece of paper and get ready to learn. Welcome to our episode on buying and holding investment real estate. But before we get started, please kindly hit those like and subscribe buttons so we can keep bringing you valuable and profitable content. We are going to tackle this topic key concept style. The first key concept is that you always want to purchase and own investment real estate in an LLC and not in your name individually. This will help to protect your personal and other business assets not owned by this LLC, since you could get sued by tenants, your tenants' visitors, contractors, buyers, neighbors, realtors, and other parties. Ideally, you should own each property in a separate LLC, so a plaintiff of a given LLC cannot get to your other properties owned by your other LLCs. This limitation of liability is very important. We have several videos on LLCs that are helpful and explain everything from the fundamentals of forming and understanding an LLC to how to maximize your protections with your LLC. The second key concept is that you want to have an agreement of sale that is drafted for a real estate investor and not an end buyer. As a real estate investor, you want provisions that many end buyer agreements of sale will not contain. For example, you will want an attorney's fees provision, a limitation of liability provision, and a provision that gives you the ability to assign the property whether to another of your LLCs or another party if it turns out you need or want to wholesale the property. There are also provisions like risk of loss that are generally not properly dealt with or included at all in many investor agreements of sale circulating between investors and on the internet. See our episode on real estate agreements of sale templates where we review in detail our investor agreement of sale. The third key concept relates to inspections. Always be sure that you select in your agreement of sale that you will have the right to perform inspections. However, as a precursor to that, always make sure you obtain a seller's property condition disclosure report for the property whenever possible and use it to help you target potential hotspots in the property. The fourth key concept is insurance. You always want to be sure that you have adequate insurance for each property. The insured on the policy should be the party that owns the property, which, as we've already discussed, should be an LLC. You can always list other affiliates as additional insureds on these insurance policies too. The fifth key concept is financing. You can pay cash, use conventional Fannie Mae, Freddie Mac financing. You can use commercial financing, private or hard money financing, or partner up with someone else. If you pay cash for the property, you will not have a mortgage payment, so the monthly cash flow will be the highest here, but it will take the most amount of cash. Let's use an example. Let's say that the purchase price of a property is $75,000, your closing costs are $5,000, and let's say the property needs a light refresher to be rentable, so there will be $5,000 in renovations. So with a cash deal, you would need about $85,000 to do this transaction. Your lowest monthly payment and least amount of cash needed should be with Fannie Mae, Freddie Mac financing, because you will get the lowest interest rate and be able to stretch the term out to 30 years and have the lowest down payment. However, these kinds of loans do have drawbacks. They will not allow you to purchase in the name of your LLC. You might be able to deed the property to your LLC after closing, but you have to consider transfer tax, title insurance, and due on sale clause issues, so discuss those with your attorney before you commit to this strategy. If you use conventional Fannie Mae Freddie Mac financing, you could finance up to 85% of the purchase price, but your closing costs will be a little higher than the cash example because of the lender fees. Therefore, you will need $11,250 down payment, which is 15% of $75,000. Let's say your closing costs are $7,000 and your renovations are $5,000 again. So you would need about $23,250 in cash in this situation. The commercial financing scenario is going to be similar to the Fannie Mae Freddie Mac scenario, except commercial lenders will allow you to purchase in the name of an LLC, even a newly formed one. You may have to put down a little more in terms of a down payment, so you could end up needing more like $30,750, and your payment will be a little higher because generally commercial loans only amortize up to 25 or 30-year terms, and the rate might be 0.25% or more higher than conventional Fannie Mae Freddie Mac loans. Private or hard money is generally not a good financing solution for rental properties because the interest rates are so high. It is hard to cash flow those properties, and they generally are designed to be short-term loans. One situation where they could be useful is if you need short-term financing to rehab the property and refinance it into a long-term permanent loan. You could also partner up with a friend, family member, or third party to help fund your deals. There are many different ways to structure this kind of relationship. You could have a capital partner who puts up all the money, and you could cut the capital partner in on the monthly cash flow. If one party's putting up all the cash and the other party found the deal and is doing all the work, the profit is usually split about 50-50. Sometimes the party putting up the money makes less than 50%. It depends on the situation. This relationship can be accomplished by forming an LLC where both parties are members. The allocation of duties and obligations, as well as the capital contributions and profit split, can be defined in the operating agreement. It could also be structured as a note and a mortgage, with the interest described as a percentage of profit on the transaction. A practice pointer here is please make sure you are detailed on how to determine the profit for a project. The sixth key concept is tax considerations. The IRS treats rental properties as passive income that is not subject to the 15.3% Medicare and Social Security tax. Therefore, you do not want the LLC taxed as an S corporation or a C corporation. However, always discuss tax issues with your CPA before making any final tax decisions. Last but certainly not least, let's cover some practical tips. Watch out for hot button issues in your area. For example, in Delaware, southeastern Pennsylvania, and southern New Jersey, stucco can be a catastrophic issue. In many parts of New Jersey, underground storage tanks are a big issue. On the Jersey Shore, riparian rights or water rights are an issue. Also, be careful who you do business with. This goes for tenants, contractors, lenders, partners, realtors, title companies, attorneys, and others. Look for people with good character that are easy to talk to and reasonably easy to get a hold of. With tenants, I recommend doing a credit check and a background check and calling references to the extent permitted in your local area. I hope you've enjoyed this episode on buying and holding investment real estate. Again, kindly hit those like and subscribe buttons so we can keep bringing you valuable and profitable content. With that said, thanks for watching, and I'll see you next time.